What's up guys, Wade here with Trade ATS. So in this presentation, I'm going to talk to you about the 6 essential rules all traders must know to win. I've been able to compile these rules as a result of working with hundreds of traders in a live classroom environment over the years, and also more recently working with thousands of traders through our online community with Trade ATS. Throughout the years, I've watched so many different traders' struggles and wins that this experience has allowed me to compile this list of what I feel is the absolute most important things that you need to know about the markets in order to have the best chance at winning long term. There's no fluff in this information. It's going to be hard hitting and direct to the point. So with that being said, let's get started. So the first thing you need to know is that most of your strategies are going to fail. Now, before you start getting discouraged and upset, let me explain a little bit further. What I'm talking about is traditional trading strategies. These are the ones that most traders are trying to use to figure out a 100% rules-based approach that completely removes emotion out of the market and they feel like they could just follow and execute on. That's what I'm talking about. Let me explain a little bit further. What I want to teach you right now is called the traditional trading strategy cycle. Now, this is not a new concept, but this is my take on it. I've seen this called the losing loop. I've seen it called the cycle of doom. I'm just going to call it the traditional trading strategy cycle. So the first stage in the strategy cycle is to find a reoccurring price pattern. So because patterns help everywhere else in our lives, we naturally look for reoccurring price patterns in the market. There's nothing wrong with this. We do have to identify something that makes sense, that we understand, that we can build an approach or a strategy around. So this is totally natural. This stage needs to happen. Where the problem comes in is in stage 2. Stage 2 is to optimize your strategy or price pattern. So this is usually going to involve conforming some sort of average base indicators or popular oscillators like MACD, ATR, and you're going to optimize these to a recent price movement. The strategy usually involves creating some sort of rigid rule structure, such as if this line crosses, I buy here or sell here, things like that. Stage 3 is now where you demo or live trade your newly optimized strategy. So after visual backtesting, most traders will go live with their new strategy. The strategy will work, listen to this, as long as the overall market condition holds. This is very important, okay? As long as the market condition holds in which you optimize that strategy around, it will continue to perform well. So if you optimized it around a ranging market, that strategy will work very well. If you optimized it to a trending market, it'll work very well there. But if those change, things are going to start to happen and it's not going to be good. So if you haven't guessed yet, stage 4 is when that market environment eventually changes, the strategy is going to start to fail. So since most strategies are over-optimized to very specific market conditions, they will eventually fail and the trader will start to distrust or lose faith in that strategy. This eventually leads the trader to start over and create a brand new strategy. So because the trader still thinks they're going to get it right the next time, they start the strategy creation process all over again. So you can see how this could be a really bad thing for a trader to get caught up in, going through this cycle over and over and over again. I can't tell you how many times I've seen people over the years get caught up in this. But once you understand why this happens, you yourself can avoid falling into this time-wasting trap. So at this point, you may be thinking, but I know that markets switch from ranges to trends already, and I have a strategy for both of them. I get it. This statement is true in its simplicity. Yes, markets do switch from ranges to trends. Yes, you can have a range trading strategy and a trend trading strategy, and you'll be all covered. I get that in its simplicity. It seems logical and easy to just use a strategy that suits the current market condition. However, the big problem is that the pip size and the time scale of ranges and trends changes significantly between cycles. So that means how big pip-wise those ranges are and the time it takes for the range to play out is enough to throw off your strategy. This creates an almost infinite combination of market conditions to optimize your system and indicator settings too. This one thing alone will render your optimized settings outdated very quickly. So if you found yourself caught up in this losing cycle, I'm going to give you some tips right now that'll dramatically improve your situation and help you out. So the first thing that you're going to want to do is you're going to want to get rid of the indicators that have lots of settings. This is especially true with oscillators, among other indicators that have any kind of settings. Remember, settings lead to over optimization and eventual strategy failure. So if you find yourself with things on your screen that you're constantly changing the deviation and the period setting, and the intensity and everything else that goes along with it, that's going to be a problem over time. The next thing is to avoid a 100% rules-based approach. So some general rules are important. General rules are things like you don't want to trade during high volume news, but fixed entry exit criteria rules will really mess you up over time. Those could be things like when the MACD crosses, I get in, or if you always have an arbitrary set distance for your stop and limit, regardless of the market structure, you're always just using, I have a 10 pip stop and a 20 pip limit. Those are types of things that are going to get you into trouble because, again, that the scale of the market and the cycles are going to change and make those specific settings not work over time. This brings me to the next point. If you must use indicators, try to use indicators that self-optimize to the different market conditions, if you can find them. Now, self-optimizing indicators are normally black box type solutions that are not widely circulated. That's why you can't really find them. The indicator that we're known for, Action Threshold Software, does self-optimize to all conditions. It's a reason why we have a ton of traders that use it. It's really good. So if you do want an indicator that self-optimizes, you can try out ATS. If you don't want to do that, your best bet is to stick with raw price action and build your strategy around that, which takes us into our next point. Learn how money exchanges hands from weak holders to strong holders and what price action specifically looks like when this happens. So you're going to want to build your strategy and approach around simple market conditions backed up by money flow analysis, which is basically where are the banks likely to take price overall. Remember, they move the market, you don't. So we'll get into more of that here in a second. I want to briefly touch on this just a little bit further. I'm going to cover this topic in more depth later in the presentation. You want to build your strategy around institutional rules. The foundation of your strategy should be based on following the same rules as the institutions. What are their rules? Analyze supply and demand, plan all trades according to available liquidity. They want liquidity to get in, liquidity to get out. For the institutions, discretion is key. They want to discreetly accumulate their positions, whether it's currencies or stocks, I don't care. They want to hide their plan, and then they want to liquidate those positions to weaker holders for profit. That's when the news release comes out. That's when the markets move. They want everyone else to come in and take those positions off their hands for a profit. That's how they trade. That's how they have to trade to be profitable at their size. The second most important thing you're going to need to know as a trader is that you need to start thinking like an institutional money manager. So let me take you through a mental exercise for a quick minute. What if you were in charge of trading with a $100 billion trading account? How would you need to trade? What would your needs be? Well, they'd be very different from someone trading a retail trading account, wouldn't they? Let's explore this a little bit further. Most likely you are trading a smaller retail trading account. Most people watching this video, that's going to be their circumstance. Remember that you and traders like you do not move markets like Forex and other high volume liquid markets. The big institutions do. Your strategy is to forecast what the institution's best play is going to be and then tag along to that. Remember, as a retail trader, you got to think of the institutional players, the big banks, like the whale swimming through the ocean. And you guys are the little sucker fish that are just trying to follow their momentum. You're trying to take a little bit of food off their backs. Okay, let's get your mind back in the institutional headspace. If you were responsible to trade huge amounts of money that can move the market, you would have one main objective: getting your trades filled at favorable price points. You would also not want anyone else to know what you're up to because it will be more difficult to accumulate profitable positions and even harder to distribute them. Think about it for a second. If, let's say, X company wanted to buy Y company, X company wouldn't want anyone to know about it until the transaction's over. Because if people know that Y company is getting bought, the price is probably going to get driven up, and then X company is going to have to pay more money for it. So This is why the big institutions want to keep their transactions under wraps. When do they want people to know about it? They want people to know about it after it's already done, after they've already accumulated their positions. Then everybody comes in, buys the company, and then the institutions can sell out later for profit if that's what their play is. But regardless, the big institutions want to keep what they're doing under wraps. Remember, institutions need willing takers to liquidate effectively. If everyone knows what they're planning and trying to do the same thing, how will they liquidate? If you were in their position, how would you liquidate? Who would you sell to? Now that you're starting to understand the real dynamics that are at play in the background, I want to make a statement that maybe some of you have already heard. Price is going to follow the path of least resistance in the market. This is usually the path that most traders think won't happen. That's where the edge is understanding where that path of least resistance is. So I want to show you a couple of quick chart examples that'll really help you get your mind around this basic process. So large market players must trade based on the model of accumulation distribution to be profitable. So on this chart, we're going to assume that there's an accumulation of sell orders that have been collected here by the institutions at this top price right here. As the market falls, profits are collected by the big banks from the distribution of buy orders in a downtrending market. So this would be like how it works in Forex. They would be accumulating sell positions. As the market moves down, they'd be buying back those positions at a lower price for profit. As the outside traders come in, they see the trend forming, they know it's happening. Now they're willing to sell the market. The market makers, the institutions, are willing to buy because they sold at a much higher price. Let's look at the reverse now. So on this chart, at the bottom, we got an accumulation of buy orders. So it's just flipped upside down, right? So as the market takes off, it starts to trend upward. Profits are collected by the banks from the distribution of sell orders in an uptrending market. So you have the retail traders indicators, everything's starting to point upward. They see the market moving. Now their trend trading strategies, all that's kicking in. Time to buy the market. The institutions can sell to them at a profit now. Now let's look at an even more detailed example of strongholder accumulation distribution. So the green dots with the B is going to be when the strongholders accumulating buy positions from weak holders, and the red dots with the S is going to be when the strongholders liquidating buy positions to weak holders for profit. So you'll be able to see that in the chart here. So we're going to start this example from the first phase of the market, which we call the contraction zone. This is a neutral area. Supply and demand are temporarily balanced in this area. You can think of this as almost like a market reset point. So in this area, this is the perfect spot for the institutions to basically come up with their battle plan. Where do they think that the market overall wants to go higher? Does it have a buy sentiment? Or overall, does it want to go lower? Does it have a sell sentiment? So this is where they figure that out, right? So let's look at the next step here. So as the market falls, you can see that all those buy orders are getting accumulated by the strongholder. We call this phase 2, which is expansion. Supply comes into the market. Favorable positions are accumulated by the strongholder for later distribution, right? So they're basically filling up their inventory with these positions. So when the institutions initially did their analysis, they knew that this market ultimately wants to go long, even though we had a pullback here. That's why they've accumulated these buy positions. Now, as the market goes up, what happens next? They're going to distribute them, right? So that demand comes into the market. Favorable positions are liquidated by the strongholder for profit. So again, who are they liquidating these positions to? It can be retail traders. It could be institutional traders. It can be anybody suffering from FOMO and chasing this trend. And that's what the institutions, the big institutions that really move markets, that's exactly what they count on. So before I move on to the next topic, I want to briefly cover some points for you to remember. Remember, your number one priority as a retail trader in analyzing the market is to understand how banks and other large institutions are competing for liquidity with each other. Remember, it's their war. They're the ones moving markets. Your objective should be to emulate their trading behavior regardless of your account size. Your strategy should be to figure out where institutions would need to get in and out of the market based on their liquidity needs. It's not your liquidity needs. Remember, you're just chasing the well. You got to think about how are they going to get filled? Where's the edge? Where's that path of least resistance? As you get better at this, you're going to develop an analysis technique that puts probability in your favor. So you may really like what you're hearing, and you may be thinking, man, I really want to dig into this. Where can I get more resources? Well, here you go. One of the resources is our YouTube channel. You know, all of our videos primarily focus on information like this, so remember to like and subscribe, right? So one thing you definitely don't want to do is you don't want to read any more books on traditional technical analysis and indicators. Instead, you want to look for books and sources that talk about how the industry works from the inside perspective. So if you see a book that says, 150 ways to use oscillators and moving averages to predict trends, that's probably something that, you'd probably want to pass on, right? Good books include titles by Richard Wyckoff and others that teach about the accumulation distribution model. How the Trading Floor Really Works by Terry Duhan is another good book to help you understand the dynamics involved in large-scale finance. So the Richard Wyckoff stuff is, he's basically the pioneer thought leader of this type of trading methodology. Great stuff can be taken from his books. They are a little outdated just because they're old. The information comes from the early 1900s, but still good stuff there. The book by Terry Duhan will really help you understand how the trading floor works, how market makers work, and all the dynamics that happen as that business is being done. So definitely helps you to get in the mindset of what's happening at those large institutions. So each source will usually have their own unique viewpoint on this matter. However, good knowledge nuggets can usually be taken from all of them. We didn't here at Trade ATS. I didn't look at just one source. I looked at a lot of sources for this information over time, and what we put together for you on this channel is just the bits of knowledge nuggets that we feel all fit together to make the most understandable way of teaching this type of methodology and explaining it. So, but by all means, look at everything and see what makes sense to you, and look for those knowledge nuggets that you can really take away from that information. Another thing you want to do is listen to interviews with bank traders, hedge fund managers, and others who run large amounts of money for institutions. Let them be your mentors. What you really want to take away is their mindset. They're not necessarily going to show you their exact trading methodology, but their mindset that they have, the professionalism that they exhibit as they do their work, that's really the stuff that you want to absorb. So let them be your mentors. And now number 3, know the true risk in selecting a Forex broker. Okay, so this is a really hot topic among new traders especially. They all want to know what broker is the best to use, which one's going to really help me win as a trader. I'm going to get right to the point on all this stuff. So what part do brokers really play in your trading? So I'm going to start off by telling you exactly what a broker's purpose is, so this is clear. The purpose of using a broker is to provide you, the trader, the liquidity you need for your trades and the access you need to the market via their trading platform, and also to provide you a data stream. That's what the broker is supposed to do. They're supposed to give you this access to the market. So as you search for a broker, let's talk about the things you're possibly going to see online as you do your research. So some online reviewers of brokers are going to tell you that different brokers will play games with your positions. They'll open and close your trades without your consent. You're going to see a lot of this type of stuff like in review forums and stuff like that. So this is possible, but it's very rare. Okay, it's rare that a broker is going to go into your account and just open and close positions without your consent. Okay, very, very rare. In most cases, trade execution problems are usually caused by user error. Let me give you an example. When new traders would come to our office years ago, the first thing they would do is load up their we used to use FXCM Trading Station back then. They would load up their charts, and the first things that they would learn is how to buy and sell in the market and set stop losses and limit orders and so forth. But one of the things when I talk about user error is that something as simple as shorting the market and only having the bid price line on, they don't know to put the ask line on there so that you can see the real-time spread between the two lines. If they short the market and then set a stop loss order for that sell position, it gets closed out by the ask price line. Now, if you don't have the ask price line on your screen, it's going to appear that your position got stopped out before the price line got to the price level that you determined for your stop loss. This alone can make you feel, when you're new, that you could, just because you don't know, could feel like, oh, the broker took me out of the market before the price even got there, and they just don't understand how the stop loss works. So little things like that can cause people to go online and write bad reviews and things like that, and say that the broker is playing games. But again, this is just an example of user error. On to my next point. Some brokers advertise low latency, immediate trade fills, which is nice, but it's not a huge advantage in the long run. Low spreads are nice too, but again, they're not going to make the difference whether you're profitable or not unless you're running high frequency trading algorithms. If you're trying to do hundreds of trades a second and you're capturing very small price movements, that's going to make a big difference, obviously. But for Forex traders, the difference between a pip and a pip and a half, or a pip and a half and 2 pips, is not going to make a huge difference if you can't predict where the market's going. Okay, so again, this is on a lot of people's radar. They're really worried about these things. Again, there's much bigger things you need to worry about than these minute details. So there's one main risk you need to be aware of when selecting a Forex broker. So before I tell you the big thing that you actually need to be concerned about when selecting a Forex broker, I need to tell you how most Forex brokers make their money. And this is apart from brokers in the United States, because this is actually not allowed in the United States. But offshore brokers in other countries, you need to be thinking about this. So most offshore brokers act as a market maker for the majority of their traders. What does this mean? Let me explain. This is a hugely profitable part of the broker's business, this act of being a market maker to their clients. They do this by running 2 separate books for their clients. Now pay attention here. You have your A book traders and you have your B book traders. So let's do A book traders first. What are these? A book traders make money overall. Their accounts grow. Might be at a small rate, might be at a big rate, but they grow. These types of traders, their trades go to the live market. The broker makes a spread commission as a revenue source. They make that markup over the market maker's base spread. So these traders are super annoying to brokers because they tie up their available liquidity from their investment bank. So this is like when the broker actually has to do the business that they advertise. They're putting the trade into the live market. They're using the liquidity credit line that they have from the investment bank to fulfill that trade. Okay, so they make the least amount of money here. It's annoying to have to facilitate this business, but it's necessary. Now B book traders. B book traders lose money overall. This is 95% of everyone else who tries a trade. Their trades typically are not going to go to the live market. Why is this? The broker knows there's a 95% chance that these traders will lose all their money, so they might as well keep it instead of giving it to the market. So this might be a little bit shocking to hear, especially if you're new to trading. You might be having some feelings about what I just said. So what does this mean for you? Let's get into that. So some traders feel the practice of keeping their trades in-house is unethical and it is some way causing them to be a losing trader. This is not true, okay? While there may be some conflict of interest with brokers and clients, when it comes to trading, you either win or lose. That is the end of the story. If you win the trade and the broker didn't send you to the live market, it is on them and they have to pay up. Doesn't matter. They assumed that risk. If you win the trade, it's time for them to pay up. If you lose a trade, it would have went to the market anyway. It still matters where you enter and exit your trades for you to be profitable. So if you continue to win, they're going to eventually move you to their A book of business and send you to the live market because you're a winning trader. They don't want to lose money on keeping your trades in-house. That's something that they're going to have to learn through exploring the relationship with you as a client. So the real risk is solvency. All this leads me up to this point. The real risk is solvency of the broker. Since the broker is acting as a market maker, if they mismanage their B-book risk, they can get cleaned out, causing them to close up shop. So they're not trading the markets. They're trading probabilities of traders. And they have to have a risk management desk inside that broker that places people either in the live market or decides to keep people in-house. So even though there's this risk, the majority of the time, things are going to work out perfectly. There is a ton of money in keeping traders' trades in-house, just keeping the deposits, because they're most likely going to lose anyway. But there is this risk, and I'm going to introduce you to a term that you may have not heard before. It's called a black swan event. On Investopedia, let's take a look at what it says. What is a black swan? A black swan is an unpredictable event that is beyond what is normally expected of a situation and has potentially severe consequences. Black swan events are characterized by their extreme rarity, severe impact, and the widespread insistence they were obvious in hindsight. Okay, so basically these black swan events are market activity that is unforeseen, that can wipe the broker out, and they can happen very quickly to a point where if a lot of their traders in that B book of business happen to be in the correct position, it could be enough to put the broker over the edge, cause that influx of money to go to those B book traders, and the broker can't pay up. In that case, they're in trouble. So this is where you'd be concerned about the safety of your deposited funds with your broker. If that black swan event hits and they're not positioned right, the broker could get cleaned out. Whether you're a winning trader or a losing trader, if you can't get access to your money, it's a problem. So now that I've scared the you-know-what out of you, how do you pick the right broker? Let's get into that. But before I give you my thoughts on picking a broker, I just want to make something really clear. TradeATS is not an introducing broker. Okay, there's no financial reward for us telling you this information. These are just our honest opinions of things that you need to be concerned about if you're looking to place your money with any given broker. So, first thing I'm going to say is use a well-known regulated broker, preferably located in either the United States, United Kingdom, or Australia, especially if you're depositing a large amount of money. Okay, now there are good offshore brokers, which we'll get to in a minute. But mostly if you're depositing a large amount of money, you're going to want to think about that extra regulation because that can serve as a major protection for your deposited funds. Just something to think about. Examples of good regulated brokers include Forex.com, which is owned by Gain Capital, and also IG has proven out to be a pretty good broker as well. Now, what about leverage and trading restrictions? I know you guys here in the US are like, well, the US kills all the fun and slams down all the rules on traders. I understand that. There are definitely some benefits to using lesser known offshore, especially CFD brokers. It's really cool to be able to trade indexes and things like that you can get offshore that you can't get with US regulated brokers. Totally get that. You get increased leverage, hedging abilities. These are examples where offshore brokers can be useful. But I'm not saying don't use those brokers, you can, but just keep in mind the risks. Understand what's going on in the background, potentially with them managing that A book and that B book of business. The smaller the broker, the more chance of insolvency developing if there is a black swan market event. So if it's an offshore broker that's well established, I know one of the ones that we like to use in-house is FX Choice, has proven to be a great broker, but no doubt, they're going to be participating in that A and B book trade management on their end. So we understand that risk, and you just need to understand that that is a risk out there when you place your funds with that broker. But above all, do your own research. Find a broker you're comfortable with. Don't just look for the broker that's going to give you the highest leverage and the biggest deposit bonuses. Just make sure that the broker that you pick has a good online reputation, or generally good at least, and that they're relatively well established. Now, beware of IBs. What does that mean? So, IB stands for Introducing Broker, which is basically an independent broker salesperson, if you will. So almost all brokers have IBs of some sort. They have some people out, whether it's in person or it's on the internet, representing them, telling people about their services. So IBs have agreements in place that allow them to share in the revenue generated by your trades. This is usually only the spread. It's not going to be those trades kept in-house, that part of the revenue. It's usually just a portion of the spread. So there's nothing inherently wrong with this arrangement, since brokers need help getting the word out about their services and they're willing to pay a commission for it. So this is not a new type of agreement. It makes sense, okay? Nothing inherently wrong. However, some IBs and brokers will offer perks and access to so-called winning strategies if you sign up with them. So that's where it could get a little bit iffy, okay? These strategies and perks are almost never in your best interest, since most brokers and IBs only care about two things, which is your trade size and how frequently you push the button, how frequently you place those trades. So the bigger you trade plus the more frequently you trade equals more money for IBs and brokers. So when you're out there cruising the internet and you see something that says get our free strategy or get our free this or that, that's probably an IB tied to a broker. And understand what the scale of motivation is here for those types of people. It's to get you to deposit money in that broker and to trade big and to trade frequently, because that's how they're going to make their money. Number 4, don't quit your day job. Now it's time to do some Googling. Goldman Sachs trader base salary. What's this all about? The typical Goldman Sachs trader salary is $120,104 per year. What? That doesn't make sense. I thought Goldman Sachs traders can make millions and millions of dollars a year. It's the world's premier finance firm. What is this all about? Let's check out JP Morgan. Oh, the typical JP Morgan trader salary is $93,226 per year. Again, another huge finance firm paying their traders base salaries. What is this all about? Morgan Stanley, $98,344 is their average base salary per year, all the way up to $279,975. So these are huge premier finance firms. You know, why would a Goldman Sachs trader need a base salary if they make so much money from trading? This is the question we're going to explore right now. So trading is all about waiting for opportunities to present themselves. I'm just going to throw that blanket statement out there, okay? Goldman traders are paid a base salary so they can wait for opportunities and, more importantly, think clearly. This base salary never goes away. They just earn against it. So how does this apply to you? You don't work for Goldman Sachs, most likely, right? What does this mean to you? What lesson can we take away from this? So if arguably the smartest investment bank in the world is paying their traders a base salary, don't you think it's important for you to have one too? Why? If you're pressured, let me step back. I'm going to say it again. If you are pressured to make money immediately from trading, then you will most likely get involved with less than ideal trading setups. If you don't have enough money to completely float your base expenses for at least a year while you learn to trade, then you need to keep your day job. You need a base salary to think clearly. These very just basic statements I'm putting out here, okay? I'm not saying don't trade. Trading is a wonderful goal. It's one of the best businesses on the planet, one of the hardest, but one of the best. But you need that stability of that basic salary. If you think I'm going to quit my job and become a trader, believe me, I've seen hundreds and hundreds of people work with them. I've seen all types of situations, including my own experience. You don't want that pressure that you take with you into each and every trading opportunity, the need to have to make grocery money. You need that predictable money at least to start. So trading is already one of the most emotionally difficult jobs to handle in the world. Don't make it worse by creating extra financial pressure on yourself. Take the lesson from Goldman Sachs, JP Morgan, Morgan Stanley. How do they ground and center their traders right off the bat? They take the desperation out of their trading decisions. They know that their basic nut is covered. They do not have to make a trade to pay their bills. Their bills are going to be covered initially. They're focused purely on quality of the opportunity, and you need to do the same thing. Number 5, properly fund your trading business. So you may be getting ready to fund some money into your live trading account, start your trading business, but you may be thinking, well, I'm going to get started on a demo account and just see how that goes. So I'm going to touch on this for a quick moment here. Only use a demo account if the following things. You're brand new to trading and you need to get familiar with the dealer platform. If you have never used MetaTrader 4 or MetaTrader 5 or TradingView or any other platform before, by all means, open a demo account, start clicking buttons, see what they got in there for tools, all that stuff. That's fine. Demo accounts are awesome to get familiar with the platform. Only use a demo account if you need to learn the actual function of trading. If you've never pressed a buy or sell button before on a dealer platform, you're going to want to do that and experiment and just get used to it. You want to learn how to set limit orders and stop loss orders, just general trading functionality. Demo accounts are great for that. The third thing, if you're testing automated strategies, definitely, this is a no-brainer, but you definitely want to run those on a demo account to make sure that they're executing correctly before you plug in a real money account. Again, total no-brainer there. So, leading to my next point, you may be thinking, well, why can't I use a demo account to become successful first? Why would I even fund money? I'm going to tell you why. Trading a demo account is lacking the true emotions of what I think are pain and pleasure. Some people call it fear and greed. I say pain and pleasure that become present when real money is on the line. Mostly pain is lacking. When that trade goes against you or you make a bunch of stupid mistakes, you're going to say, well, I wouldn't do that in my real account. You know how I know that? Because I've seen hundreds of people say the exact same thing. They say, this is just practice. I'm just going to test this out. I'm just going to put this trade. I just want to see what happens. That's not treating it seriously. That's going to go right into your live account trading. The pain and pleasure concept is a huge topic. It's something that we talk about quite a bit here at Trade ATS. If you're not familiar, we did a video. It's called The Biggest Reason Most Forex Strategies Fail and What to Do About It. If you haven't watched that video, I'd suggest go watching it. It's a little bit deep. It's a little bit long, but if you're serious about trading, I would highly recommend that you take in that video. I think it'll be pretty eye-opening for you. And now to my main point. Trading is a business that requires startup capital. How much money would it take to start most businesses? Think about any other business, maybe especially a franchise. Businesses take startup capital. You got to put some money into them to get them off the ground, right? Well, a lot of people come into Forex especially, and it's mostly because of the misconceptions that are put out on the internet, and they think that they're going to take their last $100 or $200, put it in a trade account, and compound that, to a multi-million-dollar trading account. I'm going to tell you, it's not typically how it goes, okay? So your business has to be properly funded, and you have to think about the expenses of starting that business. Trading has expenses. They come in the form of commissions, which is a spread. There's possible software and data feed expenses. If you want something more advanced, you have to pay for that stuff. And also the biggest one is losses. Yeah, losses are part of trading, and those are expenses. You have to take a few losses sometimes to figure out what the winning direction of the market is. And those are just wrapped up in expenses when losses are taken in the correct manner. Now, dumb losses from dumb mistakes, those are just losses. But anyway, understand that losses can be expenses. So how do you know how much capital you need to get started with? Now, I don't have an exact dollar amount answer for this because it's different for each and every person, okay? But I have some guidelines here. How much money do you already make at your job? How much do you make per day, per week, per month? These numbers, whatever they are, whether it's $100 a day or $1,000 a day, these numbers are going to be meaningful to you as an individual. So that's where you want to start from, okay? So if day trading, your potential trading profits and losses should be close to what you make in a day or week's work at your current job. And the reason for this is that it's going to be more meaningful. If you make $1,000 a day, let's say as a lawyer, and you're trading a $500 account, it's not going to be meaningful. It's just going to be like play money, like it just doesn't even matter, right? So if you're retired, then you're going to want to start with an amount of money that will give you the potential to safely earn enough to pay your fixed monthly or yearly expenses. Again, this is just a guideline I'm throwing out there. And it doesn't even have to be, let's say, your full monthly expenses. Maybe it's half your monthly expenses. But either way, hopefully you get my point. It has to be meaningful. If you put a whole day's work into trading or a whole week's work or a whole month's work, and you're like, wow, I made $200, but it costs you $10,000 a month for your lifestyle. Again, it's not going to keep you disciplined and keep you in the game. There's just not there's not enough upside with those numbers for you. Now, you can start with less, but keep in mind it's going to take much longer to build using proper money management rules. And that's one of the other big takeaways I want you to get from this, is that a big problem is that people are desperate and they think, I want to put my last $100 or $200 in. And with the high leverage you can get from offshore brokers, they think, well, if I just get a couple of big trades in there, I'm going to make a bunch of money, and then I'll be able to pay my groceries. I'm going to pay my rent for next month and all that. I'm going to tell you right now, you're just asking to lose that money. It's better just to keep it, wait till things calm down. Trading is not going anywhere. You'll always be able to get in the game when it's appropriate for you. Take care of your business first. Don't lose that money. So if you're not trading an amount meaningful to you, it's going to turn into a demo account. Okay. It's going to be, again, it's going to be like play money. You're going to be testing and getting in trades that don't really matter. If you're trading 10-cent pips, it's just, it's not going to be serious. And trading is very serious business, and you need to treat it seriously. Number 6, our last point, stay in the game. Don't blow up. This is an industry term, has nothing to do with dynamite. So let's clear the air there, all right? Most traders will lose or blow up several trading accounts when they get started trading. Why is this? This is usually because of combination of the following 4 things. Number 1, they're unaware of how the markets really work. They're still chasing the magic strategy. They're testing the thousands of lagging settings-based indicators out there. They're lost in that black hole. Okay, that's number 1. Number 2, they've usually adopted a short-term strategy that induces rapid firing of trades. High leverage, shooting the bazooka all the time, as many times as possible until they blow themselves up. That's usually that's a big one. Number 3, they're way over leveraged because they want to make huge unrealistic gains immediately. Again, it's that mentality of, I'm going to turn this $500 into $1 million in a month. And they're working the numbers. Again, just unrealistic. They don't understand the game that they're playing is a long distance race. Number 4, which is a big one, is that they're unaware of how their pain and pleasure response causes them to intuitively lose money. Again, that video that I recommended earlier in this video, if you haven't, go watch that one after this one. It really dives deep on this subject. I think it's a hugely important subject for you guys to grasp. So again, watch that video. So this is the big reason why most people blow up their trading accounts. So what's the antidote to this? Create realistic expectations. This is the first thing that we really need to do. Good opportunities are not always present in the market. Okay? So when you open your screen, first thing when you start trading and you find yourself and you're in a trade literally 2 minutes later, that's a bad sign. I know, because I've, again, been there, done that, seen hundreds of people do it. They'd come into the office, they'd flip their laptop on, and you'd hear "Petit" on FXCM trading stations. Like, did you see something that I didn't see? What's going on? Immediately in a trade. So understand, good opportunities are not always present. All right. When you're trading correctly, most of your gains, this is just my experience and working with other people, most of your gains will usually come from a few big winners. And the rest of the time, you're basically just trying to test good entries and trying to add small gains or at least stay at a break even. You're just kind of trying to, play the table minimum, for lack of a better analogy. You're just trying to stay in the game, and you're waiting for those trades that come across your nose, and you're just like, here it is. It's go time. I get it. I see the entry. It's time to go big. Okay? That's really what you're mostly waiting for. So understand that successful trading is mostly waiting for those types of opportunities. Having no trade is sometimes the best position to have. Just being flat, waiting for that awesome opportunity. If you get bored in the meantime and start taking less than ideal trades, you'll have a much higher chance of blowing your account. Go read a book, do some work. If you work from home, get involved with your work, just glance at the screen. You know the setups that you're looking for. If you understand how the markets really work, you know what you're looking for. Go busy yourself somewhere else, and when it's time to act and time to trade, then you'll be ready to go. Just to further drive this point home, if your account is blown, how will you be prepared to take advantage of the next perfect opportunity that presents itself? If you're constantly in trades, you're constantly getting bored, you're forcing it, then most likely you're going to be losing money. and then you're not going to have money to put into that perfect opportunity that is no doubtedly going to present itself to you. Stay in the game. If you can't play, you can't win. Protect your capital first. Be in the right mindset. Be ready to take advantage of that perfect opportunity. And that's all I got for you. So now it's up to you to get in the market, start making it happen. And if you want to see more videos with content like this, remember to like and subscribe to our channel, because this is the only types of videos that we like putting out, is stuff that we feel is extremely valuable for traders and gets right to the point. With that, we wish you the best. We'll see you on the next video.